So I get a base salary. I might have an annual bonus. That annual bonus is usually tied to those performance metrics that you're talking about. It could include earnings or revenue or certain personal things or metrics. But that long-term incentive plan is always that stock, that third piece, the long-term piece of potential value to the management team. That is always based on what is the enterprise value of the exit and some methodology of distributing it. And so in that example I used, 50 million invested, returned 100 million. Not stellar returns, but 50 goes to the investors, 50 rolled over, 5 goes to management, 45 goes over, to the original investors. And so 95 goes to the house.
I'm Felicia Shakiba, and this is CPO Playbook, where we solve a business challenge in every episode. Today, we're tackling a challenge that sits at the core of private equity success, but is rarely talked about with the honesty and clarity it deserves. The challenge is alignment. Specifically, how do you align leadership, employees, and investors after a company is acquired? It's one of the trickiest parts of post-acquisition integration. You've got new capital, a founder who may or may not stay on, employees unsure of what just happened, and private equity firms demanding results. Our guest today, Adam Coffey, has built and sold multiple billion-dollar companies across 58 acquisitions. Adam, thank you so much for joining us today.
It's good to be here. It's good to see you. I'm excited. Hello to all your listeners out there. Let's dig in.
Yeah, I'm thrilled to chat with you today. Let's start at the beginning. When you took on your first private equity-backed CEO role, what surprised you most about the alignment challenge? Was there a moment where you realized this isn't just about capital and it's about people, or was it something else?
Well, I got to be really honest with you. When I first started working with private equity, I didn't know what private equity was. I was a GE guy, and Jack was retiring into so 2001. There was this giant whooshing sound as all of the talent left GE at the same time.
Oh, okay.
Jack retired. A lot of the division heads who didn't get the nod for CEO left, went on to become CEOs of other companies, and so I was caught up in that big transition where everybody was just like, okay, what's next? Time to do something else. Private equity recruiters had been calling, and I was chasing title and money. So it was my first role as a CEO, and I didn't know what private equity was. I'm chasing money and title. And so, at the time, back at that, 25 years ago, PE was more nascent than it is today. So back then you had 1,400 firms or so. There was about 700 to 800 billion in assets under management. Today, there's tens of thousands of firms. There's 7 trillion in assets under management, and they're buying 50% of all companies bought and sold. So back in those days, I didn't really know what PE was at the time. So I didn't really know about alignment. For me, the incentives were a little bit, of an unknown, kind of a nebulous thing. But the money, the base, the bonus, the title, was like, that's what really intrigued me. I learned about alignment later, and I've seen it when you don't have alignment, and I've seen it when there is alignment. Obviously, when there's alignment, it can be a wonderful place. But when you have people at the table whose interests are divergent, then it can be a very volatile, difficult place. So the importance is huge, but I dumbed into the whole industry by accident, to be honest.
Well, I'm just curious, what was your first impression of private equity when you kind of started getting familiar with it?
Well, I was a young guy at the time, and so I had a little bit of that youthful exuberance, and I'm wondering, who are all these kids that are sitting around the table barking at me like they know what the hell they're talking about and what they're doing. And so it was like, but I'm being a little facetious. Very quickly what I learned was some very sharp people at the table. And bringing strategies to bear, financial engineering, for lack of a better term, but not in a negative sense. I mean, for me, it's like, hey, I'm building companies. They need to seek out investments, and returns for their shareholders. And if I'm going to build something big, I'm going to consume a ton of capital. And so, it's where I learned. I talked about it in my first book. It's like working with private equity is like business at a professional sport level. It's like you left high school sports or college sports and you landed in the pros, because the speed and intensity with which, the world of private equity digs into a company, is incredibly more, more intense and faster than in, a founder-led world or just a typical corporate world. In PE world, a PE fund lasts for 10 years. They have 6 years to invest their capital, and the average hold period is 5 years. And they're trying to triple, essentially the shareholder, the investors' returns who invested in their funds. And so there's a lot of work to do in a very short time period, and there is no relaxation, when you sell a business to private equity. You immediately hit the ground running. It's spring training, it's time, you're thinking as a founder potentially, hey, I just, won the lotto. I sold my business. I got a wheelbarrow full of cash, and these young guys want me to work harder, or ladies want me to work harder than I've ever worked before in my life. And it's like, it takes some getting used to, but I also find it comforting, as a founder, as an entrepreneur, as a guy who builds businesses, because that constant pressure and pushing, it's almost like, Phil Jackson coaching, Kobe Bryant and Michael Jordan and Shaq. And it's like, you have the world's best players, but even they need to be pushed to excel. It's like, new season begins. We want to win the championship. And that's what that 5-year hold period is like. And so it's very intense. I recognized very quickly this was a different environment. I came out of GE, and GE was no picnic. Let me tell you, there was a lot of intense pressure around growth there. And so I was pretty well equipped to handle that, but I was kind of shocked at the pace with which private equity moves when they're building a company and an investment.
You've said people and culture are the cornerstone of empire building. What's the first cultural misstep that private equity firms or new CEOs usually make? And how did you learn that lesson yourself?
Well, I think I learned the lesson because I grew up, from the lowest levels of a company, literally held every job you could hold in an organization, on an org chart. So, coming out of the service, I started at the bottom. I was a guy in truck, technician, engineer, worked my way up through management. And so, as a guy who used to be a line employee, a worker bee, I recognized the value that every, person brought to the table. In the military, I learned about servant leadership. I was a sergeant, but I started as a private E1 right out of high school. I was so low on the totem pole, I looked up and saw bubble gum on the bottom of somebody else's shoe. So I always thought that I, as an individual, brought value to an organization, whether it was the military or whether it was GE. And as I worked my way up the ladder, I never forgot, about the importance that all of these people, who are the people sitting in cubicles, the people who are sitting in trucks, actually bring to an organization. And I recognized very quickly that as a CEO, I could not just sit up on the top of the hill and manage revenue from the top down. If I wanted to get to revenue, I had to start with culture. It's the base of any organization. And so build a strong culture, get an engaged workforce. Engaged workforce takes care of people. People, customers love to be taken care of. They give us more stuff, and revenue just kind of rains from the skies. And so I learned, what I'll call servant leadership in the military. I learned about the importance of people and culture by working my way up through an organization. And I think a lot of times there's an arrogance of success that entrepreneurs achieve, or Fortune 500, Harvard MBAs. I'm not picking on a school, but but somebody is like, I started at the top. I started in management and I have no connection to the people in the trenches. And so I bucked that system and worked my way up from the bottom. And I had to be scrappy. And I was not always the smartest person in the room, but I knew I could outwork, outlast, get up earlier, go to bed later, and no one was going to outwork me. And I'd figure out how to find success. And so I learned that, in all actuality, in every business I've built, my success came from having a strong culture and taking care of line employees. And I called it a three-leg stool. Have to pay a fair wage in today's world or we're going to lose talent. Can't afford turnover. People don't want to work. Everybody wants to be a TikTok millionaire and sit on the couch, and nobody wants to work hard anymore. And so it's hard to find people. And if we're going to grow a big business, we're going to need a lot of people. So pay a fair wage, have great benefits, create opportunity, probably the most important one. For those people that want to sit in a cubicle for 20 years, God bless them. Every organization needs them. They're the journeymen, or the guys in the trucks for 20 years. They're the people that teach the next generation how to do the jobs that need to get done. But we also need the younger people who want to move up through an org chart, like me, who wanted to go from technician and truck to CEO, and in order to do that, we have to create opportunity, and growth is what creates those opportunities. So in a PE
Right.
environment, especially in a buy and build where we're buying a bunch of companies and putting them together, if I build a strong culture, if I pay a fair wage, have good benefits, and it's the growth that creates the opportunities, you can build something very special very quickly.
So, okay, so we know that culture is important. We know alignment is important. You have lived the experience, you've seen the good and the bad. So, now walk us through how you approach aligning leadership after an acquisition, especially when founders, particularly, are deciding, whether to step aside or stay on. Do you have a playbook, or is every situation a little bit different?
Well, I'd say the playbook is fairly common. There's nuanced differences in different situations, but I find that the same tools are going to be applied in every case. It's critical. If we want, first of all, if we're going to play business as a professional sport and we're going to expect people to operate at the pace with the level of intensity that's required, there's going to have to be some incentive in there along the way for them to do that. And private equity is probably the most generous asset class of investor out there when it comes to sharing the wealth creation, provided the wealth is created, that the returns are created for their shareholders. And so, typically to find alignment, if I'm a founder and I sold a business and I'm staying on, I roll over a portion of my proceeds and I become a shareholder in the new company that is now has a private equity majority shareholder. So I'm kind of taken care of. If I sold a company for a big price, I've rolled 30% forward, I've taken 70% out. Incentive equity isn't really designed for me as that transitioning founder. It's designed for my senior leadership team who may not have been shareholders, and the ownership may or may not have shared in that exit wealth creation with their key employees. The private equity firm is bringing a checkbook, not a leadership team. They want to invest in the leadership. And so they're hyper focused on making sure that the core of the team that they liked, that they invested in, that they built a thesis around and told their investment committees and their investors, their limited partners, how, great this company is. They got to keep that nucleus together. And so, newsflash, they don't come in and want to replace a leadership team. They want a leadership team to work hard to generate returns, and they're willing to share those returns. And so the way that they do that is they create, usually it's multiple tiers of stock, and equity comes in and they invite management to write checks and to be co-investors in the same instrument or security that they're invested in. No difference. And so they can be a check writing investor. But a lot of members of management kind of in that second tier down, if they didn't participate in the exit, if the founders didn't give them a bunch of money, they may not have a lot of money to invest. And so in order to drive alignment, to seek their engagement, to want to help create a good outcome. An incentive equity is then created, and that incentive equity is generally shared. About 10% of that class of stock is used to create a pool. I've seen it as low as 8. I've seen it as high as 14, kind of averages 10. And I'd love to talk about some changes I've been seeing recently.
Yeah.
But we create this pool of capital, and then we assign that pool to the key members of leadership that are required to kind of make that growth happen, that's going to generate the returns for the investors, the limited partners who invested in the PE fund, and the PE who then invested in by buying this company. And so they want us to participate. Now, I, as a CEO, would generally take less than what would traditionally be allotted to me as a CEO, because I wanted to push that incentive equity deeper into my organization. And I wanted more people on my leadership team to participate in the outcome of wealth creation. The more people who are incentivized, the harder everyone works. And it just gives me more of a nucleus of change agents who are willing to go the extra mile because they've got some skin in the game. So one of the things I've been seeing recently that's kind of a shift, and I think it's KKR that started the trend, is actually creating a portion of that incentive pool for the benefit of all employees in the company. And so it's not just key leaders or senior leadership, it's potentially all employees in the company. And I work with a lot of private companies now in my consulting practice. And I'm seeing a lot of founders now who are recognizing the value of incentive equity. And I'm teaching them about the need for building culture and building alignment. And so I've seen recently some of the companies that I work with create a pool of incentive equity for senior leadership, and another pool that was good for all employees in the organization. So line employees, people in cubicles, people in trucks, people working in warehouses, all having some form of incentive equity. And when they create that pool of capital, it's interesting how we ultimately designed handing it out. In one case, we took, for every year of service to the company, an employee got 1 point. At the time of exit, however many employees we had and however many points there were dictates what a point is worth. And then based on your tenure, if you were there for 20 years, you got 20 times, as a janitor, what potentially another person might have got who's only been there 1 year, but was a mid-level manager. And so I've been seeing, these tenure-based pools that have been created,
Mhm.
and these can be life-changing events. And so slowly over the decades, the incentive equity is finding its way not just to the senior most executives, but also into mid-level management, people like me pushing it deeper. PE firms like Ares, the last company that I worked with as a CEO, Ares had a 12% pool, which gave me more to work with and go deeper. But then they also created a pool for the benefit of line employees. And so we were giving out small grants, you know, and we were giving them to line employees, and we were giving out like 400 grants a year. And so almost like in a Fortune 500 world where you have a bunch of stock options to give out, I'm seeing more and more as time goes on, a willingness to create larger pools that are pushed deeper into the organization, just to that point, to drive alignment farther. If I
So
want to retain employees, I need them to feel a part of a strong organization, and for them to say, "Hey, I've got skin in the game here. Why would I leave to go work for you for another dollar an hour when I'm
right.
a I've got this long-term incentive plan?"
Yeah. Uh, I feel like this topic comes up a little bit more and more as I speak to private equity operating partners and so forth. And it's interesting because I feel like there's a lot of different ways to do it. You can say, yes, we give everyone, equity, but what exactly, like, do you know the specifics of an example that you could share of what does that incentivization look like? Because I feel like you can work that in a lot of different ways. What are you incentivizing? Are they tied to behaviors? Are they tied to revenue? Is it tied to tenure, like you said? And how much are you actually giving out? And does it depend on how big the industry is or where the business is and what stage? Like, how does that work?
Yeah, so a lot of different formulas, but variations of a common theme. So let's talk about the common theme. Let's say private equity invests $50 million of equity to buy a company. So they've got 50 million skin in the game. Usually that first 50 million, there's no benefit to the shareholders or no benefit to the employees. The return of the original equity is kind of the built-in line of demarcation. When private equity hands out stock, these are incentive units, and they're taxed at capital gains rate. And so if we gave actual stock in the company that had value, we'd be creating a taxable event. So what they do is they say Class A stock, we invested 50 million. The first 50 million of returns at exit goes to the Class A shareholders. Then Class B kicks in. And so let's say a company sells for 100 million. So the first 50 million went to the original investors. It could include employees who wrote a check, and I wrote checks every time I ran a company, but a lot of people didn't. So just the equity was returned, and those people get their money back. Now, anything that's left rolls over to a B class of stock, and that B class might now include 90% of the stock is owned by those A shareholders who put in the equity, but 10% is now owned by a management pool, and that funds the pool. So in my example, they paid 50 million of equity to buy a company. They sell it for 100 million. There's 50 million of gain. Then 10% of 50 million is 5 million. 5 million now goes into the pool. And then based upon how many people are in the pool and what percentage of that pool they own, that 5 million is then distributed on a cap table to all of those members of management. And so you could have the A shares or where the equity comes in may also include a preferred yield. So not only are they getting their 50 million back, but let's say there's a 10% yield. Then by the end of the first year, that pool is due the first 55 million. And then the next year, it would be 5.5 million added. It's now 50.5 million. And so, it's like that it adds up, it accumulates. And so and I know I just messed up the math, it's okay. But directionally, it could have a preferred yield, it may not. More sophisticated PE firms don't use preferred yields. Other ones do, so that is a point of differentiation. If I'm a founder selling a business, I might be looking at, at this, how does incentive equity work for my employees, and
Yeah.
my team? And geez, when there's a preferred yield, that could bury management behind a bunch of preferred returns, meaning there's going to be less money in the pool. So I might be mindful of looking at that. But like my last one, very fair PE firm, and they had no preferred yield on their stock. So equities returned, they get their money back. Now all the returns go into a pool where 10% was siphoned off and given to management. So that would be kind of a normal construct. Sometimes they add another class of stock, and that class of stock is above a certain return threshold.
Hmm.
Instead of 10% going to management, we're going to give 25% to management. And so I've been involved in those pools where a management team on a small amount of residual money that hit that threshold gets a ton of money because they're getting a quarter on a dollar for the profit. And so there's all these different flavors, but
Right.
essentially I issue stock, whatever I invested, that stock is going to get paid back first. Once it's paid back, money rolls over into a stock now shared by management. When management, when there's a sale event, it's funding that pool. The pool goes to a cap table based upon the number of employees and what percentages they own. That's how they get paid. And it's always based on, call it the enterprise value. So normally I get cash comp. So I get a base salary. I might have an annual bonus. That
Mhm.
annual bonus is usually tied to those performance metrics that you're talking about. It could include earnings or revenue or certain personal things or metrics. But that long-term incentive, plan is always that stock, that third piece, the long-term piece of potential value to the management team. That is always based on what is the enterprise value of the exit and some methodology of distributing it. And so in that example I used, 50 million invested, returned 100 million. Not stellar returns, but 50 goes to the investors, 50 rolled over, 5 goes to management, 45 goes over, to the original investors. And so 95 goes to the house, 5 million goes to the management team. But on a $200 million exit, it would have been $15 million in the management pool, because 50 returned to investors, 150 rolls forward, 10% of that's 15, that goes to management. So for management, the incentive is work really hard and dig in and bleed and make this happen, because you're going to participate. And the bigger the company gets and the more valuable it becomes, the bigger that pool is and the bigger your personal payday is. And so we don't focus on what is a limited partner making. We're focused on good outcome, bigger pool. What is management making?
And
That's alignment.
what's great for everyone. Okay, so you're leveraging incentives to align behaviors that ultimately will, if everyone is aligned behaviorally, they will all share in the success, which makes a lot of sense. But let's kind of test this theory, and let's say, how does a company align behaviors and culture when the company isn't hitting the mark? So you have a firm, maybe they've been, been in the private equity portfolio for 2 or 3 years now. Maybe the market has shifted. Maybe COVID struck. They're not doing well. So the constant conversation from private equity is like, we're not hitting our mark. We're not hitting our mark. Then it's like, well, what incentive do I have to work hard if I'm not going to get much out of this?
Yeah. Well, and this is a problem, right? I mean, so you're describing, the COVID was a great example because that happened a lot during COVID. So what happens when the company is not hitting its marks? Well, the first thing the private equity firm is going to do is try to do an assessment on why are we not hitting the mark. And so you have to separate external macroeconomic factors like COVID. So maybe COVID hammered your industry. You were a non-essential business, or you were, but you still got hammered, for what other reason? Your clients weren't essential businesses, or whatever the case may be. And so we have to be able to separate, is the failure to execute a macroeconomic external factor, or is it management's failure to execute? And if it's management's failure to execute, well, then the PE firm is going to change out key members of the leadership team. CEO, you got the target on your back. If
Yeah.
numbers aren't being hit and people think you aren't working hard enough to make the numbers get hit, and maybe there's some external factors, but we think it's a failure of management to execute, well, then the CEO is gone. And it could be the CFO or CRO or some other senior members of management are gone. This is nothing different than, I've got a baseball team and I'm expecting to win the World Series, and my team is not even making the playoffs. And so I've got to change the nucleus of players I've got on the field. And so it's incumbent on PE to recognize when we've got a management failure to execute and to step in and make key changes to the roster in order to get this team back on a championship trajectory. When it's a macroeconomic, condition or set of conditions, I was a CEO during the Great Recession. I was a CEO during the pandemic. So these were two times where some companies and industries got rocked. And so if management's not failing to execute, but external macroeconomic factors are impacting, well, then what I've seen PE do is try to create, okay, how do I get the best out of this situation? I don't want to lose my key leaders. And so typically what I've seen happen is in a less than optimal outcome, some type of a consolation prize, or a consolation funding, of the management pool takes place. And maybe it's not what we all wanted, but they didn't get what they wanted either. And so they redesigned that comp plan, recognizing that external factors have changed. The investment isn't going well. But at the end of the day, if they're losing money, there's not a lot of money for management to be paid. And so there could be some people who say, geez, I don't really have any long-term incentive here. I'm not going to get a payout. Time for me to bolt and go join another company that could. I'm a free agent and I'm choosing to switch teams because I want to win a championship before I retire. So these are excellent questions. And those are kind of the ranges of answers. Management failure to execute, key players are traded, changed out, new team on the field. Let's get back on track. If it's macroeconomic, might be a redesign of the comp plan to provide some kind of a incentive for management to stick around, literally, and help them finish whatever the job is that needs to be done. But a bad outcome for one is going to be a bad outcome for the other.
Yeah. Well, it sounds like leadership just plays an enormous role here, both in the decision making of how incentives are implemented, but also the decision making of the business and and how we actually grow the business. So, what would be your advice to executive leaders of private equity portfolio companies? What do you recommend for them in order to maybe keep track and making sure that they are not just hitting the goal financially, but hitting the goal, in alignment or with their people?
So I am a communicator and I believe in transparency as a CEO. And so when I was a CEO, I would regularly review numbers with my entire company. All my employees, I may have thousands of employees, I may have thousands of people out in the field doing jobs, and they don't know how much EBITDA we got. I mean, they don't know what EBITDA is, but they know how much we got, So it's like I'm talking to people about trying to educate them, trying to bring them along. Senior members of the leadership team, I'd recommend that, there's an annual review. How is the company performing? Here was the 5-year plan. Here's where we are. We're on track. We're off track. Need to work harder. Here's what's working. Here's what's not. Based on this current place, here is what management's pool is worth. Here's what your piece of this puzzle is worth. And let's have a good year. Let's work hard. Let's get that up. And over time, they're seeing the value of the stock, which may have been issued at $1, $10, $1,000, always some round number like that. And if it was at $10 and now I see it's at 15, and then I see it's at 20 and 30, that's a 3x return. And at 3.5x return, our C pool kicks in where we get 25%. It's like I keep them abreast of what the score is as the game is being played. Without that transparency, sometimes that incentive plan becomes kind of a nebulous thing where, I heard about it at first, but because I don't really know what it's worth, it doesn't have any weight. I want that plan to have weight. The leadership team is being given, I've made a lot of millionaires in my career as a CEO. Favorite time of my life is the day a company is sold and I walk around my headquarters back when we used to have headquarters and everybody was at work and not at home, and I'd look in the door and I'd see somebody and Bank of America's on the screen and they're hitting enter, 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 enter. And then, oh my God, how many zeros is that? Let me count that, and I think my last count was I've created 72 millionaires, from people who were not owners of businesses, who, were, well, I don't want to call them line employees. They may have been line employees that worked their way up. They may be executives, but they were not shareholders or owners. They weren't entrepreneurs who started something. They worked as a part of my leadership team. I think the number is 72 millionaires, that I've created. And these are people who, if you ask them, what does incentive equity look like? All smiles. I've lived the dream. I've seen it happen. I've had outcomes that weren't great. I think my worst outcome was a 2x multiple of invested capital. My best outcome was 11 times multiple of invested capital. And my career batting average is somewhere between 4 and 5. And those are good returns. I've got a bunch of Rolex watches over here rolling around on a winder. Every one of them has a logo on the back of the company I ran and the multiple of money. And usually if you make a 4x or better multiple, your partner's giving you a Rolex, and it's like,
Yeah.
I've seen it work really, really well. I've seen it work okay. I've never lost money personally on an investment in a private equity backed company.
Well, Adam, I am so impressed with, I feel like you're so on target and you've hit the bullet in so many ways. It's what we have learned also in our research. And so, best of luck to you moving forward. I think that anybody who has the opportunity to hear you speak, I think you just create value instantly. And so, thank you so much for being with me and our listeners today.
Well, thank you for having me. Hopefully everybody enjoyed that and got something useful out of it. The more we take care of our people, the more those people work hard, and ultimately that translates to value creation. And so the key is the people. So thanks for having me on. Good luck to you and good luck to everybody out there.
Visit us at cpoplaybook.com. Your support as a subscriber means the world to us. So thank you for tuning in. I'm Felicia Shakiba. Let's connect on LinkedIn.